I missed y'all. Let me just start by saying that. I've done some soul searching. I know it's been about a month since I uploaded a video, but it's been a month that I needed to take so that I could get out of my own head. See, I got my hat to the back, right? I'm sitting out on my back property. I may not necessarily be the picture of what you may think an individual man or woman would look like who is delivering this type of information, but words are words, law is law, equity is equity, no matter who it's coming from. If you stumbled upon this channel, you're in the right place. Whatever your searches are on YouTube, whatever you've watched in the past about trust has led you to this channel, to this video, and to me. Everything happens for a reason. If you're not new to the channel and you are wondering where I have been, I appreciate you. I'm back and I got a great one for you today. The video today should bridge the gap between knowing and not knowing the impact a trust will have on your tax liability. So as you can tell by the title and the thumbnail, we digging into probably one of the most important aspects of deciding how a trust can help you with your assets. So without further ado, let's dive right in. Are you confused about the differences between ordinary trust and business trust? Understanding these distinctions could save your family thousands in taxes. In this video, we'll break down how the IRS classifies trust, explore key court cases, and provide practical tips on setting up a trust to protect your family's assets. Welcome back to our channel, where we provide valuable insights into family-focused financial and legal topics. Today, we're diving into the world of trust, my ultimate favorite topic, specifically the distinctions between ordinary trust and business trust for federal tax purposes. The Internal Revenue Code, or the IRC, classifies trusts based on a specific criteria. These classifications affect how trusts are taxed, which is crucial for family financial planning. I'll explain how trusts are categorized as associations, partnerships, or ordinary trust. So to start off, let's start with some key definitions. Starting with a definition or a word that we normally think we know. I grew up thinking that this word was to describe who I am, or who you are, or who your parents are, or who your children are. But there's more to it, and that word is a person. The term person includes corporations, individuals, partnerships, trust, and more. Understanding that definition is essential for grasping how trusts are classified. The IRC sets out standards and tests to determine a trust classification. For instance, sections 301.7701-2 through -4 details several criteria. Let's get into a couple. Associations, whether the trust has multiple beneficiaries who act similarly to shareholders. Business objective, if the trust is set up to conduct business and distribute profits. Continuity of life, the trust ability to continue operating despite changes in trustees or beneficiaries. Centralization of management, whether the management is centralized similar to a corporation. Limited liability, if the liability is limited to the assets in trust. Let me say that again. If the liability is limited to the assets within the trust. Free transferability of assets. I had to say that slow. The ease with which interest in the trust can be transferred. I know that was a lot. These are definitions that you can go look up in the IRC code, but let me give you an example. It'll probably make it easier to understand, because I understand that this can be difficult, especially when you first get into it. When I first got into it about 4 years ago, it was quite difficult to wrap my mind around the concept of trust, because I didn't have all of the tools necessary to decipher the different pieces to the puzzle. So now that you're on this channel, this is a huge advantage for you and a great place to start, because the pieces to the puzzle will be presented in a way where it's easy to digest and you can follow along. So I just wanted to say that for a second, but let me give you this example to outline those definitions or those criteria that we just went over. So imagine a family trust, some mosquitoes. Imagine a family trust set up to operate a small business. If the trust operates the business, has multiple family members as beneficiaries, and profits are distributed among them, it may be classified as an association and taxed as a corporation. It's just that simple. So let's dive into some relevant court cases that outlines this fact. There's several landmark court cases that you can look into, but I'm gonna name two here, two big ones, right? The first one, Morrissey versus Commissioner. I'm gonna link the case in the description, so go check it out. But in that case, the Supreme Court stated the trust will be treated as an association if the participants have associates and an objective to carry on business and divide its profits. The case established that the operational characteristics of a trust rather than the formal structure determines its classification. It's a saying in this trust world where courts look at substance over form. I'll dig into that a little later. So stick around for how I can break that down or how you need to understand what that actually means. Substance over form. But in short, what is your trust doing? Why did you set up the trust? That's the substance. The form is the indenture. You say in the indenture, well, this trust is designed to hold assets for the benefit of the beneficiaries. Whatever those assets may be, you list them on the schedule, but then the indenture is kept in the trust book, but your trust is operating a business. Well, if the trust was dragged into court for any reason, the first thing the judge is going to do is going to look at the indenture and read the indenture. What happened in the indenture? Why was this trust created? Well, the form of the trust says that it's just there to hold the assets for the beneficiaries. However, you guys are engaged in a business for profit. So there's going to be a discrepancy there. And if the reason why you were in court is to contest paying some type of tax, it's a good chance that the judge will uphold the decision for your trust to be liable for those taxes. So this is a very important concept. I want you to get it. So let's just keep moving because it's a little bit more I need to add to this. So stay tuned. Thanks for hanging in there. Let's get to the next point or the next case. Another important case is Hecht versus Malley. Again, I'll put it in the description. Go check it out. Hecht versus Malley clarify the differences between trusts created for business and those created for mere asset protection. For instance, if a trust is created to manage rental property and the trustees actively manage the properties and distribute profits, it might be classified as a business trust, similar to the scenario in Morrissey versus Commissioner. So you may ask the question, what sets a business trust apart from ordinary trust? Here are some key characteristics. Let's think about this. Associates and profit motives. Business trusts typically have multiple participants with an intent to conduct business for profit. They often function like corporations with centralized management and continuity of life. Due to their business activities, they're subject to different regulatory and tax obligations compared to ordinary trust. The degree of control and management vested in the trustees often mirror that of corporate officers, enhancing the trust operational efficiency. So let me break that down. Here's an example. Consider a trust set up to run a family-owned restaurant. If the trust operations are similar to that of a corporation with centralized management and clear profit sharing among family members, it may be classified as a business trust. So why does this matter to your family? Knowing how your trust is classified can significantly impact your tax obligations. Properly structuring your trust documents and managing trust activities can help avoid pitfalls and ensure you take full advantage of available tax benefits. I took the ND filter off, so I looked bright all of a sudden. It was getting kind of dark. It's 7:15 p.m. I don't know what you're doing. I hope you're having a great day. So with that being said, if your family trust owns a business, consult a tax professional to ensure it's structured correctly. This can help you avoid unnecessary taxes and take advantage of potential tax benefits. For instance, distributing income to beneficiaries annually can help lower your tax liability. So we've covered the essentials, right, of trust classification according to the IRC, key definitions, standards and tests, relevant court cases, distinguishing characteristics of business trusts and their practical implications. So if you found this video helpful and you're not new to the channel, welcome back. I missed you guys a lot. If you are new to the channel, leave a like, comment, and subscribe. Do you have a trust? Are you setting up a trust? What's holding you back? Do you have a business? Would you like your business to be owned by a trust and mitigate your business taxes? Let me know in the comments. I really, really want to know. And once again, guys, I'm working on something real big, right? In a future video, we're going to talk about what it means to be a beneficiary and a U.S. person versus having a foreign trust and being a foreign person. And when I say foreign, I know you may thinking, you're talking about out in Germany or the Philippines or something? That's not what I'm talking about. I'm talking about being foreign, but from the United States of America. So stay tuned for that video because it's going to be wild. It's going to be crazy. And that's kind of why I've been gone. I've been working on how I can present this information in a way that's easily digestible. Again, it's taken me 4+ years to get to this point where I can have a conversation about the ins and outs and details of trust, whether it be irrevocable or a business, which is really all that I'm about. So if you're on this channel, just know you come to this channel, we're going to talk about irrevocable, private trust, right? And business trust, how to structure them, how to use them, and build generational wealth. So until the next video, once again, like, comment, and subscribe. We've been doing really good as far as subscribing. You guys have really been hitting me up in the email, which is below in the description, asking questions. So Let's keep that same energy. All right? See you next time. Peace.
Building up the legacy in here, play hopeless. Family first, that's the motto we live by. Stacking up the paper, aiming for the sky high. Finances on point, we taking no risks. Investing in the future, laying down the bricks. Generational wealth, that's what it's all about. Leaving a legacy that'll never be